The Fed just cut interest rates again. Is this going to finally bring some new life back to the housing market? Or is this just more noise for investors? In today's video, sponsored by Figure, we're digging into the Fed's recent actions, how it could impact mortgage rates in the short term, whether more rate cuts are on their way, and how investors should be updating their strategies based on this news. Hey everyone, I'm Dave Meyer. Thanks for joining us here today. As you've probably heard already, the Federal Reserve just cut rates for the third consecutive meeting, doing basically what everyone, economists and investors, expected them to do. As of now, the federal funds rate now sits between 3.5% and 3.75%. And the Fed has really been on a roll. They've been cutting rates a lot over the last 15 months. It may not seem like that because mortgage rates have stayed a little bit high, but they've actually cut the federal funds rate 1.75% in just the last 15 months. Now, I mentioned that what happened here today, and it does matter, and we're going to get into what this means for real estate investors in just a minute, is a little different than rate cuts that we have seen over the last 15 months. In this vote, that's the way that this thing happens. Everyone pays attention to what Jerome Powell is doing. He's the Fed chair, but there's actually 12 people who vote on interest rate decisions. And normally, maybe there's one person who doesn't agree, maybe there's two people, but this time we actually had three Fed officials who voted against this cut. Might not sound like a big disagreement for 3 of the 12 to disagree, but it is the first time in 6 years there were 3 Fed officials disagreeing. Now that tells us a little bit here about what's going to happen in the future, because it means that the Fed is a little bit divided. Not everyone is agreeing on what happens next, and that introduces a whole new element of uncertainty that we'll talk about here. But I want to mention first that of those 3 people who dissented, did not vote for this, it actually went in both directions. There were 2 voters who said that the cut wasn't warranted. Meanwhile, 1 voted, said that there should have been a bigger half-point cut. So that actually just shows that there's going to be a lot of uncertainty going forward. But as of right now, 9 of the 12 voters felt that cutting rates was the appropriate move to stave off any potential trouble in the labor market, and felt that the risk of increased inflation, which can happen when you cut rates and lower rates, that was worth it. The risk of more inflation was worth it because they're more worried about the labor market than they are with inflation. Now, when we look forward, that's the big question. People saw this coming, but no one really knows what happens from here. And the fact that there was 3 dissenters shows that there's going to be this uncertainty. They put out these press conferences, they put out statements. It's always very measured, they're very careful about what they're going to say. What we saw from Jerome Powell and from what's called the Summary of Economic Projections, that's like their estimates of what's going to happen, is in 2026, they're actually only forecasting 1 more rate cut. As of right now, the Fed is saying that they are going to end 2025 with the median federal funds rate at 3.6%. They expected 2026, the next year, just to go down to 3.4%. Not that big of a change. Then in 2027, it will go down to 3.1%. 2028, also 3.1%. So they're saying, yeah, they've cut rates quite a bit, but they're not really going to change it all that much over the next couple of years. At least that's their forecast as of now. As you've probably noticed over the last couple of months, when the Fed cuts rates, that does not directly correlate with changes in the mortgage markets. So let's turn our attention now to what is going on with mortgage rates, because that is what we as real estate investors are really going to care about. What happened is that mortgage rates didn't really change that much. What we're seeing as of today, it could change a little bit tomorrow, but as of today, recording this right after the Fed announcement came out, yields on 10-year U.S. Treasuries, which is almost directly correlated with mortgage rates, they haven't really changed. And in fact, they've actually gone up since the Fed started cutting rates again back in September. Back in September, they're about 4%. As of now, they're about 4.2%. And that's been the difference of mortgage rates that were coming down to 6.1-ish%. But now, as of today, at least as of this recording, they're at about 6.35%. pretty similar where we've been in the last couple months, but up a little bit. So overall, I think this move by the Fed, this cut in the federal funds rate, is kind of a big nothing when it comes to residential mortgage rates. We have seen them be volatile over the last couple of months, and I expect we are still going to see volatility in the residential mortgage market going forward. For mortgage rates to go down in a sustainable way where they actually stay down, we actually don't really need the Fed to do anything. Like, it could help if they keep cutting rates, but what we really need to see is bond yields to fall, which can either come from a recession, which no one really wants, but some people really want mortgage rates, so maybe they prefer that, but either a recession or, in my opinion, the better option is inflation coming back down. Those are the two things that I think could reliably bring down mortgage rates. Of course, other things that can happen, but just looking back at history, these are the kinds of things that can help bring down mortgage rates. So it would be good if we saw inflation start coming back down. I'm not saying it's going to be good if we have a recession, but that could lead to lower rates. The problem is we don't have a clear line of sight on either of these things, right? We don't know if inflation's coming back down. It's gone up 4 months in a row. We're about to get data in a couple weeks for the last month, but it's been going back up. Some people think there's going to be a recession. Other people think, including the Fed, I should say, do not think there's going to be a recession. The Fed actually is expecting 2.3% real GDP growth in 2026. So they're not seeing a recession coming. So I just want to call out that as of right now, there's not really a clear path to lower sustainable mortgage rates. Now, I should mention that if you are into commercial real estate and you look at adjustable rate mortgages, this could help with those kinds of loans a little bit, this federal funds rate reduction. But for the 30-year fixed on a residential mortgage, it's really just not going to change that much. So then, what does that mean for real estate investors? Like, what do we actually do with continuously volatile mortgage rates and an uncertain path to the Fed? I'm going to share with you a couple of ideas or things that I'm personally doing with my own portfolio that you can consider as well. Number one is do not wait for rates to change. I've been saying this for a while. If you watch this channel or follow me on Instagram or listen to the podcast, you know I've been saying this for a while, but rates are very volatile and they are likely not going to fall as much as people think. There's a good chance they go down next year a little bit. There's a good chance that they might go back up if we see inflation start to pick up. So if you want to be active in the housing market right now, the key is to lock in your rate right now. That is the key, because honestly, if you are analyzing a deal, underwriting a deal, what matters is the rate you can get today. If the deal makes sense at current rates, what happens in the future could be gravy, or you might find yourself super happy that you locked in a rate because rates actually go up in the long run. And I want to call out how valuable this is because I actually, on Instagram, I had posted something about this before the first September rate cut. I said, I think mortgage rates are going to go up after the rate cut. And I know no one else was believing that, but I kept saying it. And at least one person listened to me, and he recently just sent me a DM on Instagram saying that I saved him more than $400 per month because he locked in that rate and did not wait to try and time the market perfectly. He found a deal and a rate that made sense for him, was able to go out and get a deal, and is doing really well right now. Now, I think this is true for purchases. If you're going to go out and buy something new, you can lock in a rate. That is what I recommend to most people. There are also other things that you can do right now to lock in financing that can help you grow your portfolio. One of the interesting things that is developing in the housing market right now is that homeowners have a lot of equity in their deals. Actually, almost half of all homeowners are eligible to take out a line of credit against their home and use that to go make more purchases. This is probably one of the most common things I hear about investing right now is that, how do you find money to make your next deal? Well, on average, the average homeowner has almost $200,000 in equity that they can borrow against. And this is a really good strategy right now because you can borrow money at a fixed rate. You can get access to funding quickly and you can draw cash as needed, even if rates haven't come down to the point where you feel like refinancing. So locking in rates is something I really recommend. The other thing I'm really just fond of in general as a strategy in this kind of volatile market is using fixed rate debt. That kind of goes into what I was saying with locked in, but I think, this is just something I believe long-term interest rates, I'm not talking about this year or next year. I'm talking like 5 years, 10 years from now. I'm very uncertain about that. When you look at our national debt, I think there is a decent chance that they might be higher in 5 to 10 years. I know no one else really thinks that, but there are real fundamentals that might point to that. I just think if you're going out to buy a deal and lock in a rate today, like I said, my strong preference for people is to use fixed rate debt, because to me, that reduces a lot of risk in real estate investing. And that's kind of my whole thing, is how do you take advantage of the upside of real estate investing while taking the minimum amount of risk that you have to? To me, getting fixed rate debt is the way to do that, because if your deal pencils now, if you can underwrite it now and it works with fixed rate debt, you don't have to worry about rates going up in the future, right? You still have the opportunity to refinance if rates go down in the future, but you don't have the risk of rates going up in the future. To me, that's kind of an ideal situation with how uncertain the economy is right now. One other thing, while we're talking about financing and locking in rates, I think one other thing that a lot of people aren't using or considering for financing right now is taking out a home equity line of credit. This is a fantastic way. If you're looking for money to fund your next deal or to do a renovation, you can actually get fixed rate home equity lines of credit where you can lock in a borrowing cost and you can just use those monies as you need, right? You can draw cash when you need. If you don't need it, you're not paying for it. If you do need it and want to go use it for something, that's when you pay for it, and you can get a fixed rate option, which is the kind of debt I like. The cool thing about this is we're in this unique part of the housing market where actually tons of homeowners are eligible for this. Nearly 50% have accessible equity. The average amount that they can take out is almost $200,000. So this is a really powerful option for people. And if you look at companies like Figure who offer these fixed rate HELOC structures, that means that your rate stays predictable regardless of what the Fed's doing, regardless of our national debt and what happens 5 to 10 years. You get to lock in those competitive rates from day one, and you have a lot of flexibility. Having that flexibility of a HELOC in an uncertain market like this allows you to take advantage of opportunity, again, without taking on unnecessary risk, which is my recommendation to everyone. One other thing I would just advise, as we're in December right now, this time of year is a great time for looking for deals. Seasonally, it's actually one of the lowest times of year for prices. Often prices drop 2, 3, 4% from summer just because it's winter. There's less people looking. There's less demand. The people who are putting their homes on the market now are usually pretty motivated. People who listed their properties for sale in the fall and haven't sold them are probably feeling a little itchy to go out and sell. So I actually think this is a really good time to start looking for deals. Even though mortgage rates are probably not going to drop today or tomorrow, there are other reasons why housing might get more affordable just because prices drop in the next couple of months. And so I think this is a good time to at least look at and underwrite a lot of deals to see if you can find a great opportunity, because personally, I think there's going to be more and more of them. So that's it. That's my reaction to the Federal Reserve meeting here in December. Again, they cut rates 25 basis points, but the future, the outlook is very uncertain. As of right now, the Fed is saying that they are only anticipating cutting rates one more time in 2026, but even that is uncertain. We're seeing dissent and disagreement among Fed governors, and that just makes the job for us as real estate investors a little less clear, which is why I recommend, if you are going to participate in the market, and I've said before, and I'll say again, I think there's going to be great buying opportunities as we enter this housing correction. Prices are going to go down. There are going to be better opportunities. And the way you take advantage of that without taking on too much risk is locking in the rates, either by getting a new purchase or using a HELOC like the fixed rate options Figure has to offer. That's what we got for you guys today. Thank you so much for checking out this Fed reaction video. For Bigger Pockets, I'm Dave Meyer. We'll see you next time.